Why do investors panic when markets fall but stay calm when they rise slowly? The answer lies in loss aversion, one of the most powerful psychological biases in finance. In this video, we'll explore how the fear of losing money affects decision-making, why most people sell too early or hold too long, and how to train your mind to think like a disciplined investor. Learn the psychology behind risk, emotion, and rational investing. #investor psychology, #loss aversion, #behavioral finance, #investing, #trading mindset. Video tags. Loss aversion, behavioral finance, investor psychology, fear of loss, emotional investing, trading psychology, decision-making in investing, cognitive bias, money mindset, investing mistakes. Fear and greed, investor behavior, financial discipline, stock market psychology, risk perception. Market emotions, investing education, rational investing, long-term investing. Psychology of money. Voiceover script approximately equals 13,800 characters. If you've ever felt that losing money hurts more than gaining it, feels good, you're not alone. In fact, this emotional imbalance is hardwired into our psychology. It's called loss aversion, and it's one of the most powerful forces shaping investor behavior. Simply put, loss aversion means that the pain of losing is psychologically about twice as strong as the pleasure of gaining. This single bias drives countless bad investment decisions, from panic selling during downturns to holding losing stocks in the hope they'll come back. It's not just emotional, it's biological. Our brains evolved to prioritize survival, not financial optimization. For ancient humans, avoiding loss, like staying alive or keeping scarce resources, was far more critical than chasing gains. Those instincts still control us today, even in modern markets. Let's see how that plays out in real-world investing. When markets fall, investors feel immediate emotional pain. It triggers the same neural responses as physical danger: fear, stress, anxiety. The brain's amygdala activates, flooding the body with cortisol and adrenaline. Your instinct: protect yourself. In financial terms, that means selling often at the worst possible time. But when markets rise slowly, the emotional reaction is much weaker. We enjoy the gain, but not enough to outweigh the pain we felt before. That's why people tend to sell winners too early and hold losers too long. They want to lock in the feeling of relief and avoid more pain. Here's a classic example. An investor buys a stock at $100. It drops to $80. Instead of cutting the loss, they hold it hoping it returns to $100. The logic: I haven't lost until I sell. But that's not true. The value is already gone, only the acknowledgement is missing. That refusal to accept loss keeps investors trapped. Sometimes, that $80 stock drops to $60, then $40, and by the time the investor capitulates, the loss is permanent. The irony: that same investor might sell another stock after a small 10% gain, just to feel like they've won something. In the end, the portfolio suffers from asymmetry: small wins, big losses. That's loss aversion in action, emotionally satisfying in the moment, financially destructive over time. Now, let's put numbers behind this. In behavioral economics, studies show that most people require a potential gain of about twice the size of a potential loss to take the same risk. For example, if losing $100 feels painful, you'd need a possible gain of $200 or more to feel equally motivated to take that risk. This explains why investors prefer low-risk, low-return assets, even when higher returns would be more rational long-term. It also explains why markets can overreact to bad news. Fear amplifies the downside far more than optimism amplifies the upside. In fact, during downturns, loss aversion drives herd behavior. Investors collectively rush to safety, pushing prices down even more. The result: markets become temporarily irrational, creating opportunity for those who can think beyond emotion. So the key question is, how can you overcome loss aversion? You can't eliminate it. It's part of being human, but you can manage it. Here are 5 strategies that smart investors use. 1. Reframe your perspective. Instead of thinking I lost $1,000, think I paid $1,000 to learn something about market behavior. Losses are tuition fees for experience. Reframing helps reduce emotional intensity. 2. Focus on long-term probabilities, not short-term outcomes. If your investment plan is sound, short-term losses don't matter. Zoom out. The longer your horizon, the less emotional noise affects your decision-making. 3. Use data, not emotion. Base buy and sell decisions on predefined rules, not feelings. For example, I'll sell if the company's fundamentals deteriorate, not I'll sell if I feel nervous. 4. Automate decisions where possible. Dollar cost averaging, automatic rebalancing, and consistent contribution plans reduce the influence of emotion. You don't have to feel ready, you just act systematically. 5. Diversify. Diversification is not just about reducing financial risk, it also reduces emotional risk. When one asset underperforms, others can stabilize your portfolio and your psychology. Now, let's explore the subtle ways loss aversion distorts perception. When you're in profit, you tend to underestimate risk, you feel confident, sometimes even overconfident. But when you're in loss, the same risk feels magnified. This bias makes it harder to think objectively during market turbulence. Professional traders deal with this by predefining their losses. They use stop losses, risk limits, or position sizing to ensure no single loss is catastrophic. The decision to exit is made before the emotion kicks in. In contrast, retail investors often make decisions during emotional peaks, when fear or greed is strongest. That's exactly when the brain is least rational. Loss aversion also explains why paper losses feel less painful than realized ones. Investors tell themselves, I'll wait until it recovers, because selling turns a theoretical loss into a real one. But this denial keeps portfolios bloated with underperforming assets. Smart investors flip that script. They'd rather take a small, controlled loss early than let it become a big one later. As the saying goes, cut losses quickly, let winners run. Let's go deeper into the psychology. Loss aversion interacts with anchoring, another cognitive bias. When we buy something at a certain price, we anchor to that number. If the price drops, we measure our performance relative to that anchor, even if market conditions have changed. That's why people say, I'll sell when it gets back to what I paid. But markets don't care what you paid, they move based on fundamentals and sentiment, not personal anchors. Combining loss aversion and anchoring creates a powerful psychological trap, one that keeps investors emotionally stuck in losing positions. To break that trap, you must learn to see investments as probabilities, not personal stories. Every trade has an expected value, a mix of potential gain, potential loss, and probability. If the math doesn't justify the risk, walk away, emotion aside. Let's talk about how professionals train their minds to deal with loss. They develop what's called emotional neutrality. They treat gains and losses as data points, not validations or failures. It's a form of mental discipline that takes practice. Here's how you can start developing it. Keep a trading or investing journal. Write down why you entered a position and what outcome you expected. After the result, review the decision process, not the profit or loss. Over time, this trains your brain to value process over outcome. Because the truth is, you can make a good decision and still lose money, just as you can make a bad decision and get lucky. The goal isn't perfection, it's consistency. Loss aversion makes people focus on avoiding pain, but successful investing is about accepting discomfort as part of growth. Every investor experiences losses. What separates winners from losers is how they respond. When you stop fearing losses and start managing them intelligently, you gain emotional control. That control is your real edge. So next time you feel the urge to panic, sell, or wait until it comes back, pause. Ask yourself, am I acting on analysis or emotion? If it's emotion, step back. Look at the data. Remember that your goal isn't to win every trade, it has to make consistently rational decisions over time. Because in the long run, it's not the market that defeats most investors, it's their own psychology. To wrap up, here are 3 key takeaways. Loss aversion is natural but dangerous. Be aware of it. Accept losses as part of the process. Don't personalize them. Build systems that remove emotion from decision-making. If you master this mindset, you'll stop being controlled by fear and start acting from strategy.